if you're a trader. Watch this.
The market moves in your favor, that's not bad luck. It's liquidity sweeps at work. In this video, we'll talk about how to master liquidity and turn sweeps into real profits. If you want to stop donating your stop losses to the market, hit that like button and let's dive in. What is liquidity? Liquidity is the pool of stop losses and pending orders around obvious highs, lows, trend lines, equal highs, support, and resistance. At resistance, you'll have reversal traders placing short orders with their stop losses above. You'll also have breakout traders placing long orders with their stop losses below. This creates a pool of orders stacked in these areas, which creates liquidity. Price will often move past these areas, trapping both short sellers and breakout traders before starting the true reversal downwards, which is a liquidity sweep. The reason this happens is because large institutions intentionally target the resting liquidity at these key levels. And once all that liquidity is absorbed, they use this liquidity to fill their own large orders before pushing price drastically in the intended direction. For example, on this chart, many traders notice that price is forming a trendline pattern. Every time price respects that trendline, their confidence grows. So what do next? They wait for another break of structure to confirm that the bullish momentum is still strong. After that, they draw a trend line and wait for a retracement to place a limit order. Or, when support and resistance traders see price consolidating in a tight range, they mark support below and resistance above, then wait to see which level price will break. Once the resistance is broken, they become more confident and they immediately place a limit order at the new demand zone. But then something unexpected happens. Price gives a small reaction and suddenly reverses to the downside, triggering their stop loss. So the real question is, how can traders take advantage of this type of price action instead of becoming the ones who lose? You need to analyze the price action carefully to determine whether the move is likely a continuation or a potential reversal. To understand the context, there are three important questions you should always ask yourself. What is the higher and medium timeframe momentum? Does the price action align with the higher timeframe direction? Is the price currently trading at a premium, discount, and equilibrium level? These are the timeframes we can look at to identify our higher timeframe. Now that we know what our timeframe is, how can we identify the higher timeframe momentum? Look for consistent highs and lows. When price reaches the most recent high, we can identify it as an uptrend. When price reaches the most recent low, we call it a downtrend. That move is what we call a break of structure. When we identify the trend, we can look now for valid break